Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Factory sector is in retreat. Construction spending is the highest it has been since 2008, and yet factory employment never really recovered from the pandemic. That's the core paradox in this article from the Wall Street Journal. The factory sector is officially in retreat, even as headline numbers scream, manufacturing boom. On paper, it looks like a renaissance. On the ground, CEOs are talking about lost years, tariff headaches, and why China and Mexico still beat Michigan and Massachusetts when it comes to new plants. I see this as another round in a familiar cycle. Politicians launch big industrial policies, tariffs, and subsidies. Companies talk reshoring. Spending lines on charts look great for a while. But the actual operating decisions, where to build, who to hire, what to automate, are governed by basic incentives and returns on capital. And those incentives often point away from the story politicians want you to believe. Let me walk you through the central figures in this piece, because that's where the signal is. First, you've got the operators, CEOs like H.O. Woltz III at Insteel Industries and Harold Bevis at NN. These people run real businesses. Insteel takes steel and turns it into wire that reinforces concrete infrastructure, including big projects like the Gordie Howe Bridge between Detroit and Canada. NN makes precision metal components for trucks and cars, parts that end up in steering systems, audiovisual controls, and other hard, boring essential bits. They're builders. Woltz's job is to turn raw steel into reinforcing products for bridges and other structures. He wants a steady, affordable supply of steel, ideally domestic. Bevis's job at NN is to keep 23 plants across 6 countries humming, balancing labor, input costs, and demand from customers like Ford and General Motors. They're allocators. Woltz has to decide whether to rely on U.S. steel or to import from places like Algeria and India when domestic supply is thin. He's not allocating capital in a spreadsheet. He's allocating his company's supply chain between tariff-free and tariff-hit sources. Bevis is deciding where to put the next dollar of capacity: Michigan or Mexico, Massachusetts or China. NN has already trimmed its U.S. workforce to compete with low-cost factories abroad and to respond to slower-than-expected electric vehicle growth. That's capital allocation in the wild. And they are constraints themselves. They can't wish away 50% tariffs on foreign steel. They can't ignore surging prices for gold and silver that NN uses in some products. They can't pretend U.S. policy isn't stop and go. When tariffs change, when Supreme Court cases threaten to unwind some import taxes, when demand in autos or trucks swings, their own prior decisions constrain how fast they can pivot. So what worked for a while? For a while, the idea of tariffs plus subsidies plus big-ticket project announcements seemed to work. Tariffs were presented as a way to shield domestic producers from foreign steel, from Chinese components, from cheap imports generally. At the same time, the Trump administration muscled trading partners like Japan and South Korea into deals that included commitments to invest hundreds of billions of dollars in the U.S. Big names announced massive projects. Apple, TSMC, AstraZeneca, and others unveiled plans to build or expand facilities that could, on paper, create thousands of manufacturing jobs. On a chart, all of that shows up as rising nominal manufacturing construction spending. On screen, I'd show you that first chart from the article. Picture a graph with time on the horizontal axis, starting around 2008 and running through 2025. The vertical axis is manufacturing construction spending at an annualized rate, measured in billions of dollars. You see spending relatively subdued after the financial crisis, then rising, and by 22,425 it's pushing up toward the $200 billion a year mark. A second line on the same chart shows inflation-adjusted investment in manufacturing, lagging a bit in real terms but also elevated. What's being measured is the dollar value of construction projects, plants, facilities, factories, underway in the U.S. Imagine another graph with years from 2019 through 2025 on the x-axis and U.S. manufacturing jobs on the y-axis. In millions, you see employment dip sharply during the pandemic, then climb back, but it stalls below 2019's peak. The line hovers, maybe edges up a bit, but doesn't shoot higher even as construction spending does. The caption says, "Most since 2008, referring to job levels, but visually you see a sector that is recovering, not booming. That line measures headcount, not spending. It matters because it reveals the gap between CapEx headlines and actual employment. What the chart's creator is really saying is, yes, we're building, but we're not hiring the way we used to. Let's talk about the inflection point the article is highlighting. We've moved from a story of tariffs and incentives as easy fixes to a story of friction, uncertainty, and trade-offs. The environment changed. Tariffs on foreign steel were doubled to 50% this year. China and other countries kept pumping out exports despite tariffs, pushing down global prices in markets where U.S. manufacturers struggle to compete. The Supreme Court may nullify some import taxes, adding legal uncertainty on top of economic uncertainty. The White House has threatened new tariffs on Europe, Canada, and South Korea, again and again. The same tariff that was sold as a shield has become, in many cases, a tax on inputs. InSteel, for example, now finds it increasingly difficult to get enough steel from U.S. suppliers at reasonable terms. As a result, it has, at times, turned to tariffed imports from Algeria, India, and elsewhere just to keep up with demand for projects like the Gordie Howe Bridge. H.O. Waltz says it plainly. There's very little in our product portfolio that has benefited from tariffs. Copying the past. Simply adding more tariffs, more headline projects, more ad hoc deals, fails because the structure of global supply chains and the cost base of U.S. producers have changed. The article also makes it clear that automation and technology are changing the relationship between investment and jobs. Analysts expect new investments to focus heavily on robotic tools and artificial intelligence components. That's where Wall Street's capital is most excited. That means the factories being built are far more capital-intensive and far less labor-intensive than older plants. You can't just copy the mid-20th century playbook. Big plants, big payrolls, and expect it to work when robots, software, and AI are the incremental hires. Evolution is unavoidable because productivity is rising. The White House itself is pointing out that manufacturing productivity has ticked up in recent quarters, and that wage increases for existing workers have outpaced inflation over the past year. You can have better jobs for some workers without having more jobs overall. Now, let's do the capital allocation autopsy. Decision 1. Double tariffs on foreign steel to 50% and broadly expand tariffs on Chinese and other imports. What was expected? Policymakers selling this expected to make domestic steel and other industrial producers more competitive by raising the cost of foreign competition. The hope was that higher prices on imports would translate into better margins and more investment at home, leading to more jobs and more factory construction. What actually happened on the ground, as the article describes, is more complicated. For a company like InSteel, tariffs have indeed made foreign steel more expensive, but domestic steel producers haven't always been able or willing to supply enough volume at acceptable prices. That leaves InSteel short of raw material. To meet demand on projects like the Gordie Howe Bridge, they end up importing steel from Algeria, India, and elsewhere, and paying the tariffs anyway. The opportunity cost here is significant. Capital that could have been used to expand capacity, improve processes, or move into higher margin products is instead spent just to stand still, covering higher input costs, managing supply friction, and dealing with volatility in metal markets that are also being buffeted by global speculation and price swings. The hidden trade-off is that tariffs aimed at helping producers often end up hurting downstream manufacturers who buy those inputs. You see that at NN as well, where tariffs have helped push up costs for steel and aluminum on top of soaring market prices for gold and silver used in some products. Their CEO, Harold Bevis, says bluntly, "So you take a hit." Most failures come from success carried too far. Here, the success is politically popular tariffs that demonstrate toughness on China and other trading partners. Carried too far, they morph into a cost problem for the very domestic manufacturers they were supposed to help. Decision 2. Heavy promotion of big-ticket investment announcements. Apple, TSMC, AstraZeneca, and the rest, as proof of a manufacturing revival. What was expected? The administration expected that forcing trading partners into deals that included hundreds of billions of dollars of U.S. investment commitments would create self-sufficient domestic industries, especially in semiconductors, EVs, batteries, and pharmaceuticals. These projects were billed as catalysts for thousands of permanent manufacturing jobs. What actually happened so far, according to the article, is that the timeline is long and the labor impact is uncertain. Trump himself says, "I don't know when all of this money is going to kick in." Analysts quoted in the piece suggest that new investments will skew toward robotic tools and AI components, the stuff that excites markets but doesn't hire armies of line workers. Opportunity cost? By focusing political capital and subsidies on marquee projects and cutting deals with foreign firms, there's a risk of underinvesting in the less glamorous, smaller manufacturers who form the backbone of domestic supply chains. While the headlines focus on one chip fab or one pharma plant, hundreds of mid-sized suppliers face higher input costs, demand volatility, and uncertain policy. Hidden trade-off? Making sectors self-sufficient often means baking in higher capital intensity and higher fixed costs. These plants will be hard to mothball and expensive to keep running if the policy winds shift. Again, success. Getting the plants built can plant the seeds of future rigidity. Decision 3. Company-level choices about where to expand. Let's take NN as an example. NN has 23 plants in 6 countries. In response to low-cost foreign competition and a slowdown in EV demand, it trimmed its U.S. workforce. At the same time, it sees opportunities in new sectors like data centers and electrical equipment, where demand is growing. Bevis says that as they evaluate where to expand for the auto business, places like Michigan and Massachusetts are still a hard sell compared with Mexico, where many products remain tariff-free under the existing trade deal. Investing to supply the auto market in China, where NN already has 3 factories, also looks like a safer bet than building more footprint in the U.S. The opportunity cost for the U.S. is clear. Every plant NN decides to expand in China or Mexico instead of Michigan is future cash flow, future learning, and future ecosystem development that accrues abroad. For NN's shareholders, the opportunity cost of ignoring Mexican or Chinese options would be lower returns and less competitive cost structures. The hidden trade-off is that even as the U.S. tries to reshore, its own policy volatility, stop-and-start tariffs, legal uncertainty, changing EV incentives, pushes rational managers to place capital in jurisdictions where the industrial strategy is more predictable, even if the politics are uncomfortable. Now, let's go back to the visuals, because this article is built around them. On screen, alongside the construction and jobs chart, we should show one more image the journal uses. A photo of workers preparing to weld a steel tube at HCC in Mendota, Illinois, a company that uses parts to make combines. You see welding sparks, heavy machinery, and a worker in protective gear. That image is measuring something qualitative, the reality of factory work. It matters because it anchors the discussion in actual metal, actual welders, actual plant floors. What most people miss, looking at that kind of photo, is how many tasks around that welder are now automated or semi-automated, and how the same amount of visual busyness can represent far fewer total employees than in prior decades. Then we overlay the chart, the bars of construction spending, the line of manufacturing jobs. The creator of that chart is really saying, the money is flowing, but the headcount isn't. Time for the reality check. First, on their own, are a blunt tool. They can help some domestic producers in narrow segments, but for many manufacturers who buy inputs from abroad, they are simply a tax. H.O. Waltz's comment, that very little in Insteel's portfolio has actually benefited from tariffs, cuts directly against the political narrative. Second, the factory boom story is heavily capital-weighted and automation-weighted. Construction spending and robot purchases look great in aggregate data. But if the goal is broad-based manufacturing employment, the path is not straightforward. Productivity gains mean that even when output stabilizes or rises, the number of jobs can stagnate or fall. The article notes that manufacturing productivity has picked up and wage gains have outpaced inflation for those still employed, but the total jobs line hasn't bounced back to pre-pandemic levels. Third, policy uncertainty is a form of anti-investment tax. The article is explicit that the White House's stop-and-start approach, threatening new tariffs on allies like Europe, Canada, and South Korea, has led many executives to view 2005 as a lost year for investment. Add in the risk that the Supreme Court could void some import taxes, and you get an environment where waiting often beats building. So what does all this mean for us as long-term business quality investors? Lesson 1. Incentives, not slogans, drive where factories go. Tariffs may sound tough, but what really shapes NN's site selection is total cost, policy predictability, and customer proximity. If China is consolidating its auto supply chains faster, or if Mexico offers tariff-free access with lower labor costs, that's where rational capital goes. Our job as investors is to watch those actual flows, not the speeches. Lesson 2. Scale can become a disadvantage when it locks in high fixed costs without flexible demand. The U.S. is pushing huge, capital-intensive manufacturing projects. If they're well chosen, they can be wonderful assets. If they're driven more by politics than by economics, they can become stranded plants that are too expensive to close, but too unproductive to earn adequate returns. For us, that means we should favor companies and projects that can adapt their footprints, not ones that are politically anchored to one geography or one product. Lesson 3. Success plants the seeds of future vulnerability when it encourages complacency. Tariffs and subsidies can feel like a safety net. They can make an industry look safer than it is. But if that success slows down real competitiveness, improvements on cost, on quality, on speed, then the long-term position worsens. You see that in Bevis's comparison. China is moving at a way faster pace to shore up its own supply chains. U.S. policy that makes people think they're protected can lull them into underinvesting in the hard, unglamorous work of productivity. So, what core question is this Wall Street Journal article asking? It's asking whether the combination of tariffs, big-ticket announcements, and episodic industrial policy is actually creating a durable, competitive U.S. factory base, or whether it's producing a strange hybrid. Record construction spending, modest productivity gains, but a factory sector that still feels like it's in retreat to the people running the plants. My answer, reading this as a value investor, is that the true health of manufacturing will show up not in how much money we pour into concrete, but in whether operators like Insteel and NN can earn solid returns on capital in the U.S. without relying on temporary policy crutches. Until their site selection math tilts decisively toward Michigan over Mexico, we should treat the manufacturing boom narrative with caution. And the sentence I'd want you to remember for years is this. Whenever you hear about a factory renaissance, look past the construction cranes and ask whether the people who actually run plants are choosing to grow here because it's competitive, not because tariffs and politics temporarily make everywhere else look worse. Moving to next title, Senate probes Swiss accounts Nazi links, potentially tied to Nazis at Credit Suisse, decades after a settlement that was supposed to close this chapter forever. This is from the Wall Street Journal, and it matters because it's not just about history. It's about how a modern global bank like UBS thinks about legacy liabilities, transparency, and the trade-off between short-term legal containment and long-term trust. When a bank tells the world, "We settled this in the 90s," and new evidence keeps surfacing, that's not just a moral problem, it's a business quality problem. I see this as one more round in a long cycle. Big institutions cut deals to resolve past misconduct, declare closure, and move on. Then time passes, someone digs deeper, and the question comes back. Did they really tell us everything? As value investors, we have to train ourselves to look at how firms respond to that second wave of scrutiny, because that response tells us a lot about their culture of decision-making and capital allocation. Let's identify the central figures in this story. On one side, you have UBS, now the dominant Swiss bank after rescuing Credit Suisse in March 2023 with backing from the Swiss government. UBS's America's president, Rob Karofsky, and its chief lawyer appear before the Senate Judiciary Committee. They are the current stewards of this legacy. UBS absorbed Credit Suisse's assets, liabilities, archives, and reputational baggage. They are builders of the new combined bank, but they're also custodians of an old story. They're allocators too. They're allocating legal risk, reputational capital, and internal resources. They let Neil Barofsky's team roam deep into Credit Suisse's archives, which is how these additional accounts came to light. That's an allocation decision. Spend money and political capital to dig, or stonewall and hope the story fades. At the same time, UBS has refused to share information about Credit Suisse's legal decision-making around the 1990 settlement, and it has declined to open its own war-era archives. It previously acknowledged destroying records in the 90s that might have been relevant, records a night watchman literally saw being destroyed and partially saved. And they are constraints. UBS has to live within the constraints of a settlement struck in the late 1990s with UBS and Credit Suisse, a settlement that resulted in nearly $1.3 billion in payments. That deal was intended to compensate bank account holders, slave laborers, and others whose assets were looted or who were refused refuge in Switzerland. It was supposed to draw a line under Swiss banks' activities in that era forever. That line is now a constraint. UBS does not want it reopened. On the other side, you have Neil Barofsky and the Simon Wiesenthal Center. Barofsky is a former U.S. prosecutor, now a partner at Jenner & Block. He was hired by Credit Suisse in 2021, after the Simon Wiesenthal Center found new information on possible Nazi clients that hadn't been previously disclosed. Credit Suisse later fired him in 2022 for what they called overreaching his mandate. After UBS took over in 2023, it rehired him to continue the probe. He's a builder in a different sense. He's constructing a factual. He found accounts held by the German Foreign Office, which helped in the mass deportation of Jews to concentration camps. He identified accounts held by SS agents. He found previously unreported examples of Credit Suisse carrying out forced transfers of Jewish clients' assets into Nazi-affiliated banks. He found indications that Credit Suisse helped fleeing officials resettle in Argentina after the war. Around 890 accounts potentially tied to Nazis. That's not a rounding error. The Simon Wiesenthal Center is the moral constraint in this story. It was the center's findings that triggered Barofsky's appointment in 2021. It's the center that's now facing a UBS move in Brooklyn Federal Court, where UBS is asking a judge to effectively tell the center and other Jewish groups who participated in the 1990 settlement, you can't question the settlement's validity, you can't seek additional payments, and you can't cause or promote any public controversy over the settlement and the Swiss bank's conduct. From UBS's perspective, they want certainty. They want the 90s settlement to be final. From the center's perspective, this looks like an attempt to silence criticism. In a letter to the judge, the center's lawyers say the sweeping language would obstruct their First Amendment rights and their long-standing mission to investigate and bring to light the full scope of the anti-Semitic campaign engaged in by the Nazis. So what worked for a long time? For decades after World War II, Swiss banks turned away families of Holocaust victims, saying they had no records of their loved ones' accounts and assets. Neutral Switzerland denied suggestions it helped finance the Nazis or profited from their terror. The political and legal establishment largely accepted this narrative. Then, in the late 90s, everything shifted. After years of diplomatic wrangling and denials from UBS and Credit Suisse that they were harboring significant amounts of money for Jewish victims or had done meaningful business with Nazis, the banks struck that big settlement. Nearly $1.3 billion. It was designed to compensate bank account holders, slave laborers, and others who suffered at their hands, and to close the book. That settlement worked, in the narrow sense. It diffused intense international pressure. It provided real money to victims and their descendants. It allowed the banks to say, we've addressed this, we've paid, we're moving on. For a long time, that line held. What quietly stopped working was the assumption that the record was complete. The Simon Wiesenthal Center found new information in 2020 that hadn't been disclosed. Barofsky's dive into the archives produced more. Those 890 accounts, the German Foreign Office links, the SS accounts, the forced transfers, the post-war escape routes to Argentina. The idea that the 1990s investigation and settlement had surfaced everything significant was no longer tenable. That's the inflection point. The environment changed when UBS decided to acquire a failing Credit Suisse in March 2023. Suddenly, what had been Credit Suisse's problem was now UBS's problem. UBS told the Senate it wants to bring greater transparency to Switzerland's dark chapter, helping the Nazis in World War II. It voluntarily let Barofsky's team into Credit Suisse's archives. That's one direction. At the same time, UBS is refusing to share information about Credit Suisse's legal decision-making in the 1990s, the very period when the settlement was crafted, declining to open its own war-era archives, separate from Credit Suisse's, seeking a court order to make explicit that the 90s settlement disallows any further legal action or additional payments, and to prohibit groups from promoting public controversy over the settlement and Swiss banks' conduct. The contrast between "we're bringing transparency" and "we want a judge to tell critics to be quiet and never ask for more" is the heart of this inflection point. Copying the past, asserting closure, relying on the settlement, hoping new details stay buried, fails because the new evidence exists, has been described under oath in the U.S. Senate, and is being reported in a major outlet like the Wall Street Journal. Evolution is unavoidable here. UBS can't go back to the pre-Barofsky status quo. The question is what evolution looks like. Does it mean a fuller accounting? Perhaps more disclosures? Perhaps some symbolic or even financial gestures that acknowledge the new findings? Or does it mean doubling down on the legalistic argument that the 1990 settlement covers everything no matter what is discovered now? That choice is a capital allocation decision as much as a legal one. Let's walk through UBS's key decisions as a decision autopsy. Decision 1. Rescue Credit Suisse in March 2023, with Swiss government backing. What was expected? UBS expected to stabilize the Swiss banking system, acquire a rival at distressed prices, and build a stronger franchise. The deal promised scale, client relationships, and synergies. There was always an understanding that Credit Suisse came with baggage, recent scandals, poor risk management, and some legacy issues. What actually happened, as the article shows, is that UBS also inherited a long-running investigation into Nazi-era accounts. It inherited an independent investigator that Credit Suisse had fired for overreach. Opportunity cost? By taking on Credit Suisse, UBS tied its own reputation to a set of unresolved historical issues. It could have remained the less implicated Swiss bank in the public mind. Instead, it is now front and center before the U.S. Senate, defending not just its own past, but Credit Suisse's. That can distract management, attention, constrain strategy, and influence how regulators and counterparties view the group. Hidden trade-off? The cheaper the financial price paid for Credit Suisse, the more likely it is that intangible costs, like this reputational overhang, show up later. Again, most failures come from success carried too far. The success here is pulling off a bold rescue acquisition. The shadow is that you also buy every skeleton in the closet. Decision 2. Limit cooperation around legal decision-making and push for a broad protective court order in Brooklyn. What was expected from UBS's side? UBS wants legal certainty. It wants assurances that opening up lawyer memos and internal deliberations around the 1990 settlement won't trigger new lawsuits or reopen the settlement. It wants an explicit judicial statement that the settlement disallows any further legal action or additional payments, and it wants organizations who endorsed it barred from causing or promoting public controversy over it. What actually happened in public perception? In the Senate hearing, and in the Wall Street Journal's telling, this move looks like an attempt to muzzle a watchdog. UBS is telling Congress and the press that it wants transparency about a dark chapter, but it's simultaneously asking a federal judge to tell the Simon Wiesenthal Center to hold its tongue and never ask for more money. The opportunity cost is credibility. Every time UBS emphasizes finality over full disclosure, it spends a bit of the reputational capital it claims to be building. For long-term investors and counterparties, that matters more than whatever incremental legal protection the order might bring. The hidden trade-off is simple. You may win in court and lose in the court of public opinion. You may avoid additional payouts today, but cement a perception that you care more about closing the file than about truth. For a bank whose entire business is trust in safekeeping, trust in confidentiality, trust in integrity, that's a serious long-term risk. Decision 3. UBS's stance on its own archives and the destroyed records. UBS has declined to open its war-era archives, separate from Credit Suisse's. It previously acknowledged destroying records in the 90s that could have been relevant to Nazi-era inquiries. Those destructions were revealed not by the bank, but by a night watchman who saw it happening and saved some documents. The expected benefit of not opening those archives is straightforward. Fewer risks of new revelations, fewer routes to claims that the 1990 settlement didn't resolve everything. The actual consequence, especially when contrasted with Borofsky's findings, is the impression that the full story is still not out. The more new material emerges from Credit Suisse's side, the more natural it is for observers to ask, what would we see if UBS's own records were fully opened? The opportunity cost is the chance to truly reset. A bank that voluntarily opens its archives and says, here is everything, even if it hurts, has a path to long-term respect. A bank that dribbles out cooperation while citing past record destruction invites ongoing suspicion. The hidden trade-off is that opacity buys time but not closure. The more you rely on missing records as a shield, the more every surviving document becomes an event when it surfaces. Now, let's make the visuals in this article vivid, because they're important to the narrative. On screen, we should first show the Senate Judiciary Committee hearing room. You see Neil Borofsky at the witness table in the foreground, flanked by others, including a rabbi from the Simon Wiesenthal Center and UBS executives. Behind them, senators sit on the dais, nameplates, microphones, stacks of paper. The caption tells you this is a Senate Judiciary Committee hearing in Washington. What's being measured in that image is institutional attention. When a Senate committee dedicates a hearing to your conduct, it signals that this is not a niche archival question. It matters because it elevates the issue from academic debate to political oversight. What most people miss is that these hearings don't just influence law, they influence how global investors and counterparties perceive policy risk around a firm. Then, on screen, you show a photograph of Josh D'Amaro or Bob Iger, and you might think, wrong topic. But the page layout in the journal puts these stories side by side. That juxtaposition matters thematically. On one half of the page, you have a modern CEO succession at Disney, with big numbers around compensation and streaming strategy. On the other half, you have a bank dealing with unfinished business from the 1940s. It's a reminder that corporate storytelling doesn't happen in a vacuum. Legacy and future sit next to each other. The key data in the Swiss story are not in a numeric chart this time. They're in those counts and sums. Nearly $1.3 billion in the 1990 settlement. Around 890 accounts potentially tied to Nazis. The presence of accounts linked to the German Foreign Office and SS agents. The fact that UBS and Credit Suisse absorbed smaller banks after World War II, weaving those histories into their own. When you lay those numbers on screen as text, with subdued typography, the viewer can feel the scale. The journal's narrative is measuring both money and moral weight. Time for the reality check. First, uncomfortable truth. A settlement can buy time, but it doesn't automatically buy closure if the underlying facts weren't fully known. The 1990 settlement was huge, nearly $1.3 billion. It was negotiated after years of denials. It was intended to draw a line under the bank's conduct. But if that settlement was based on incomplete records or incomplete disclosure, later evidence is going to reopen the question in the public sphere, even if the legal language says otherwise. Second, reputation is a compounding asset, just like capital. Except in reverse, small withdrawals add up. UBS wants to say it is bringing transparency to Switzerland's dark chapter, yet it is also asking a court to tell critics not to cause public controversy. That's a withdrawal. UBS acknowledged destroying records in the 90s, revealed by a night watchman, and has not fully opened its own archives. Another withdrawal. Each move may make sense tactically, but reputational compounding works through consistent, credible behavior over long periods. Third, for us as investors, this is a reminder that legal finality and economic finality are not the same thing. A bank can secure a court order that says, no more claims, no more payments, no more controversies. But markets, customers, and regulators don't have to accept that emotionally. They can adjust counterparty limits, regulatory scrutiny, or the willingness to grant a benefit of the doubt. Those changes don't show up in a single headline. They show up over years, in cost of capital, in regulatory friction, in the ability to attract and retain clients who care about how their wealth was earned and is protected. So, what are the 3 timeless lessons I take from this Wall Street Journal piece? Lesson 1. Incentives shape how much truth an institution is willing to reveal. UBS's incentives are clear. Protect the 90 settlement, avoid reopening liabilities, and get on with integrating Credit Suisse. The Simon Wiesenthal Center's incentive is to uncover the full scope of Nazi-era conduct and seek justice, not to preserve UBS's earnings. The success here was Switzerland's ability, for decades, to position itself as neutral, discreet, and safe, while denying meaningful Nazi ties and turning away Holocaust survivors' families. That narrative helped Swiss banks grow. But it also meant that when the truth emerged, the backlash was more intense, the settlements larger, and the trust damage deeper. A culture that learns to deny uncomfortable truths, because it works in the short run, becomes structurally fragile in the long run. So what is the core question this article is asking? It's asking whether a modern, systemically important bank can genuinely put a dark historical chapter behind it by leaning on legal finality, or whether the only durable way forward is full, sometimes painful transparency, even if it risks reopening old deals. My answer, wearing my long-term investor hat, is that in the age of searchable archives, activist NGOs, and global political scrutiny, legal shields are temporary. The only compounding asset that truly endures is earned trust, and you only earn it by being more honest about your past than you are legally forced to be. And the sentence I'd want you to remember for years is this: whenever a bank tells you a scandal is fully settled, ask yourself whether they've really finished the story or just paid enough to stop people from turning the page for a while. Moving to next title, India's Strategy 1 Tariff Reprieve. President Trump hit India with tariffs of 50% on exports to the U.S., among the highest in the world. And India responded by getting its tariffs cut to 18%. That's the punchline of this Wall Street Journal story. And it matters because it shows you how a supposedly weaker player, a so-called middle power, can turn a hostile trade move into negotiating leverage. Instead of folding or retaliating blindly, India treated this like what it is, a long game about incentives, options, and who needs whom more over time. I see this as another round in a familiar cycle. A major power uses tariffs and public pressure to force alignment. The target country can either react emotionally, match the rhetoric, escalate, and lock itself in, or it can quietly build alternatives, create FOMO, and wait for the bigger player to blink. India chose the second path. Let's talk about the central figures and how they behave as builders, allocators, and constraints. On one side, you have Prime Minister Narendra Modi and his government in New Delhi. Modi is not a founder in the corporate sense, but in this story, he's very much a builder. He's building India's position as a credible, indispensable middle power. He's building that position with trade deals and with discipline. While Trump's White House aides were calling Russia's invasion of Ukraine Modi's war and deriding India as the Kremlin's laundromat for buying Russian oil, Modi didn't rise to the bait. He stayed quiet. That stoicism is a form of construction. It preserved optionality. It allowed Trump to keep saying the two men remained friends and kept the channel open. He's also an allocator. Modi's government allocated attention and time to deals with other economies. It made agreements with the United Kingdom. It pushed through a big deal with the European Union that both sides described as the mother of all deals. It scheduled trade talks with Canada, even after Canada had accused Indian authorities of involvement in an extrajudicial killing on Canadian soil back in 2002-03. Those are capital allocation decisions, just at the level of national capacity, instead of a corporate balance sheet. You only have so many negotiators, so much domestic political capital. Choosing to spend that on the UK, the EU, and Canada while you're under tariff fire from the US is a signal. We have options. Modi is also a constraint in this story because his decision not to lash out at the insults from Washington sets the tone for the entire bureaucracy. If he had chosen to go public, to match the rhetoric, the path to the eventual tariff cut would have been much harder. On the other side, you have President Trump and his team. Trump is using tariffs as his primary tool. He first imposes 50% tariffs on India's exports to the U.S., among the highest tariffs applied to any major economy last year. Then, when India doesn't fold, he stacks on more. In July, New Delhi thinks a trade deal is close. But by the end of that month, the administration says India hasn't done enough to lower trade barriers and singles it out among buyers of Russian oil. Trump accuses India of indirectly funding Russia's war machine and punishes it with 25% tariffs on top of 25% reciprocal tariffs. Put differently, he doubles down. That's the success carried too far pattern starting to form. Trump is also an allocator. He dispatches Sergio Gore, a close aide, as ambassador to India in January. That's not a token move. That's Trump spending a scarce asset, a loyal aide, to reset the relationship. On Monday, after all this build-up, he says he's cutting tariffs on Indian products to 18%. That's a decision to allocate the remaining leverage differently. Less punishment, more partnership, at least in public. The article makes it clear that what worked for a while was raw pressure. High tariffs seemed like they would scare capital away from India. And in the short run, they did. The levies that took effect in August contributed to more uncertainty about the risks of investing in India. Institutional investors pulled billions of dollars out of the country in 2025. The rupee fell. India's government tried to cushion the blow with spending and tax cuts to stimulate demand. That helped support economic growth in the near term, but as the article says, it wasn't a long-term solution. You can't permanently offset external shocks with fiscal sugar. What quietly stopped working was the assumption that India would simply eat the tariffs and keep taking the hits to capital flows and currency, because it had no alternatives. Instead, India moved on two tracks: quiet diplomacy with the U.S., refusing to escalate the rhetoric and offering targeted concessions; loud diplomacy with everyone else, making a big deal of its agreements with other major markets. The inflection point is when those two tracks intersect with U.S. domestic incentives. On screen, I'd show you the key sequence. First, the tariffs. 50%, take that number and put it in big type on a neutral background with the words, "Tariffs on India's exports to the U.S." beneath it. That is one of the highest tariffs in the world last year. It measures punishment, but also overconfidence. It matters because at 50%, you are not fine-tuning. You are trying to bludgeon. Then, on Monday, that number drops to 18%. Again, show 18% on screen, with the caption, "Trump announces cut in tariffs on Indian products." That contrast is what the article is about. What most people miss is that the path from 50 to 18 wasn't about India apologizing or surrendering. It was about India making itself too attractive to ignore. Let's walk through the decisions that got us here. Decision 1. India's choice to keep buying Russian oil despite U.S. criticism, but to do it in a way that left room to negotiate. What was expected from Washington's side? The U.S. expected that shaming India, calling Russia's invasion Modi's war, labeling India the Kremlin's laundromat, plus tariff pressure would force New Delhi to cut off Russian oil quickly and visibly, in a way that U.S. politicians could sell as a victory. What actually happened? India kept buying Russian oil for a time because it was economically rational. Trying to replace Russian oil wholly with U.S. supplies would be difficult and expensive for Indian refineries, as energy analysts in the article point out. But over time, India made significant reductions. It did not trumpet them. It let the data and the flows do the talking. The opportunity cost for India was real. It risked U.S. anger, tariffs, and capital outflows. But the trade-off was cheaper energy and a diversified supply. The hidden trade-off for the U.S. was that by pushing too hard publicly, it made it harder to acknowledge India's gradual adjustment without losing face. So, eventually, Trump flips the narrative. He asserts that India won't buy any more Russian oil and frames the tariff cut as an American victory. New Delhi, notably, doesn't confirm that it has agreed to curtail its Russian oil purchases. The Kremlin says it hasn't received such a message. Most failures come from success carried too far. Here, success was public shaming plus tariffs. Carried too far, it risked pushing India into other blocs. Decision 2. India's decision to aggressively pursue trade deals with others, the UK, the EU, Canada, while it was under U.S. tariffs. What was expected? Some might have expected India to go into a defensive crouch, focus inward, complain, and try to get Washington to relent. What actually happened is the opposite. India and the European Union agreed to what they described as the mother of all deals. India offered big cuts to levies on European alcohol. It pledged to lower tariffs on a quota of European cars to 10% over time, from as high as 110% now. That's a huge concession compared with the status quo. India also speeded toward a trade pact with Canada, despite a brutal diplomatic clash just a couple of years ago when Canada alleged that Indian authorities were tied to an extrajudicial killing on Canadian territory, an allegation India denied. On screen, I'd show a simple table, current tariff on some European cars, up to 110%. New _line, target tariff on that quota under the EU deal, 10% over time. That table measures openness. It matters because it signals to the world's capital allocators, and to the White House, that India's market is not closed. It's just choosing who gets the best terms. What most people miss is that these concessions are as much about signaling to Washington as they are about Europe or Canada. The opportunity cost for India is giving Europeans and Canadians more access, which might weaken some domestic incumbents. But the hidden trade-off is strategic. By doing these deals, India creates FOMO in the White House, fear of missing out on the vast Indian consumer market, and that FOMO becomes leverage. Decision 3. India's choice to offer targeted concessions to the U.S. that fit American priorities, nuclear energy, AI, and big-ticket imports, without surrendering its entire position. India allowed private investment in nuclear energy. That's a significant opening. On Sunday, it announced a tax break for AI data centers, a move that promises to be a boon for U.S. tech giants. These are capital allocation decisions. India is choosing to forego some tax revenue now to attract strategic investment in AI and data infrastructure. Trump, for his part, says India will buy hundreds of billions of dollars worth of energy, agricultural products, and other goods from the U.S. Analysts quoted in the article are skeptical that India can reach that scale unless it is given a decade or more. The opportunity cost for India is that if it truly commits to buying those hundreds of billions over time, it could tilt its import basket more toward the U.S. than is strictly optimal on price alone. But the article is careful. Analysts doubt those numbers on the proposed timeline. That suggests India is agreeing in principle with an understanding that the adjustment path will be long. The hidden trade-off for the U.S. is that it's publicly promising export gains that may be politically difficult to deliver if India insists on a gradual schedule. Overpromising now can create internal political pressure later. Now on screen, I'd have you see 3 visuals, in sequence, because they tell the story. First, a photograph of Modi, composed, unsmiling, probably at a podium, captioned as using quiet diplomacy to reach an accord with the U.S. You see him in traditional attire with flags behind him. That image measures tone. It matters because it underscores that he did not play this as a shouting match. He played it as a long game. Second, a simple numerical call-out of capital flows. Billions of dollars of institutional investor funds flowed out of India in 2005 after tariffs took effect, and the rupee's value declined. Even without exact figures in the article, those phrases show direction. They measure pain. What people miss is that India absorbed that pain long enough to improve its bargaining position, instead of conceding quickly. Third, the mother of all deals line with the EU paired with the tariff numbers on cars and alcohol. That measures how much India was willing to give up elsewhere to strengthen its hand with Washington. The creator is really saying, this is not a country with no options. Time for the reality check. The uncomfortable truth the article is surfacing is that tariffs are a double-edged sword. Trump's 50% tariffs did cause pain in India. Capital outflows, rupee weakness, investment uncertainty. But they also forced India to accelerate diversification and gave it a domestic political mandate to seek better terms elsewhere. Over time, the tariffs turned from a symbol of U.S. strength into a lever India could use. By moving closer to the EU and Canada, it made the cost of maintaining those tariffs higher for Washington. Another uncomfortable truth. India's government spending and tax cuts to support growth are a band-aid, not a cure. They helped support India's economic growth recently, as the piece says, but they didn't offer a long-term solution. The long-term solution is exactly what Modi pursued: reshaping trade relationships and securing less punitive access to key markets. Third, perception and reality diverge in how this outcome is framed. Trump frames the drop in tariffs as an American victory, tied to an assertion that India won't buy any more Russian oil. Modi stays quiet. New Delhi doesn't confirm. The Kremlin explicitly says it hasn't received such a message. Analysts note that fully replacing Russian oil with U.S. supplies would be difficult and expensive. The reality is likely partial adjustment, not total compliance. As investors, we care about the structural direction, not the spin. The direction is, India is reducing some dependence on Russian oil, building deeper ties with the EU and Canada, and extracting a tariff reprieve from the U.S. That combination is what improves its long-term positioning. So, what are the 3 lessons I take from this as a value investor? Lesson 1. Incentives shape outcomes more than threats do. India understood that what Washington ultimately wants is access. Access to a big, growing market for energy, agricultural products, and goods. Access to a strategic partner that's not China. Access to investment opportunities in AI and nuclear. By shaping those incentives, doing the EU deal, moving toward Canada, offering tax breaks for AI data centers, India made it rational for Trump to cut tariffs. The threats didn't evaporate. The incentives changed. Lesson 2. Scale becomes a disadvantage if you rely too much on blunt tools. The U.S. has scale. It can slap 50% tariffs on a major partner. But when you escalate to that level, you leave yourself little room to adjust. Bringing tariffs down from 50 to 18% is a public climb down, no matter how you spin it. For corporate analogs, think of a dominant buyer that squeezes suppliers so hard that they invest with competitors instead. Scale allows pressure. Overuse of pressure erodes future leverage. Lesson 3. Success plants the seeds of future failure when it encourages your counterpart to build alternatives. Tariffs and insults might feel powerful in the moment. They can generate domestic applause, but they also give the other side a clear signal. We cannot rely on you. The article shows India responding by signing what it calls the mother of all deals with the EU and speeding toward a pact with Canada, that is, planting seeds of a future where India's dependency on the U.S. is lower, and where it can choose partners. For investors, this is a reminder to be wary of companies and countries that overplay their hand with customers or suppliers. So what's the core question this Wall Street Journal article is asking? It's asking whether a middle power like India can turn asymmetric pressure into a better long-term position by diversifying partners, staying disciplined in public, and offering targeted concessions that fit the big power's narrative. My answer is yes, and India just wrote a playbook. It took a hit, endured a year of pain, built alternative routes, and then collected a tariff reprieve without publicly backing down on core interests, like its energy mix. That is exactly what we look for in high-quality management teams: endurance, optionality, and an ability to make the other side think your win was their idea. And the sentence I'd want you to remember for years is this: when a stronger player hits you with tariffs, the real power move is not to shout back, but to quietly build so many other bridges that, in the end, they have to lower the toll to stay in the game. Moving to next title, Argentines pressed to stop hiding dollars. Argentines have more than $250 billion stashed at home, in offshore accounts and safe deposit boxes, some 6 times the reserves of the central bank. That's the scale of the challenge in this Wall Street Journal piece, and it matters because it's not just about money. It's about trust, incentives, and whether a libertarian leader like Javier Milei can convince a traumatized population to participate in their own economic revival. 2 years into his term, private sector dollar deposits in banks have hit a record of nearly $37 billion, up 160% since he took office. That's progress. But the mattress dollars are still the elephant in the room. I see this as a classic cycle. Hyperinflation and capital controls destroy trust in institutions. Citizens hoard hard assets. Governments swing between amnesties and crackdowns. Each cycle reinforces the hoarding habit. Milei is trying to break it, not with force, but by changing incentives and reducing risks. Let's focus on the central figure, Javier Milei. Milei is Argentina's president, a self-described libertarian who took office in December 2023. He's won over President Trump and wooed global investors. Now he's taking on the hardest task, persuading crisis-weary Argentines to stop hoarding U.S. dollars. He's a builder. He's building trust in the financial system. He's building a free market revamp that requires those dollars to flow from teddy bears, chair legs, ceilings, backyards, and safe deposit boxes back into banks. With more dollars available, lenders can expand loans and export credit, boosting growth and easing the pain of austerity. He's an allocator. Milei is allocating political capital and policy bandwidth to this. Congress passed a law in December to raise tax evasion thresholds, allowing Argentines to use up to $70,000 in some cases, without declaring the origin of the cash-up. From a previous threshold, where using more than $1,000 risked prosecution. A similar tax amnesty under Milei in 2024 coaxed about $24 billion back into the financial system and led Argentines to declare roughly 55,000 properties. That's allocation. Spend credibility on amnesties now to unlock capital for the future. And he's a constrained. Milei is constrained by Argentina's history. The 2001 financial collapse, when the government froze bank deposits and blocked cash withdrawals, wiped out families' life savings and sparked protests. Wild swings in the peso, bank freezes, and other capital controls over decades destroyed trust. That history is now in the DNA of every Argentine saver. It constrains how fast Milei can move. What worked for a long time was hoarding. Keeping dollars under the mattress has long been a national ritual. Argentines take pride in their ingenuity. Hector Orsenigo hid his in the metal tube of a chair leg. Patricia Fernandez remembers lifting the cover of a window blind to find her parents' secret bag. Families stumble upon dollars in heirlooms from long-deceased relatives. Safe deposit boxes boomed as a bellwether of distrust. Juan Piantoni, CEO of Ingot, the company that rents them in Buenos Aires, says business exploded in the past decade. Now, Ingot predicts as much as a 15% decline this year. They're even pitching Argentines to use the boxes for letters from former girlfriends instead of cash. This worked in the narrow sense that it preserved value. Dollars don't inflate like pesos. They don't get frozen in banks. But what quietly stopped working was the assumption that hoarding forever was sustainable. Inflation eroded pesos. Undeclared dollars couldn't be used productively. Unearthing cash was risky. Families faced prosecution for unpaid taxes. Some preferred to risk losing it in floods or fires rather than declare it. Juan Trufa recalls a flood at a bank where staff used hair dryers to dry millions of dollars from safe deposit boxes, money whose owners still refused to declare or deposit it. Milei's reforms are changing that calculus. The inflection point is 2 years into his term. Dollar deposits in banks by the private sector hit nearly $37 billion in late 2005, up 160% since he took office. On screen, I'd show the chart from the article. Picture a line graph with years from 22 to 22.5 on the horizontal axis. The vertical axis is dollar deposits in Argentina by the private sector, from 0 to $40 billion. The line starts low, ticks up, and by late 2005, it's at a record nearly $37 billion. Key annotations: President Javier Milei in office at the start of 2004, and July 2004, Milei launches first tax amnesty, marking a sharp uptick. That line measures confidence. It matters because it shows actual behavior changing. What most people miss is the scale. Even at $37 billion, that's just a fraction of the estimated $250 billion stashed elsewhere. The creator is really saying, progress, but the mountain is still huge. What's changing is the risk-reward of hoarding versus banking. Milei's government is softening financial controls. Congress raised the tax evasion threshold to $70,000 in some cases. The new law shifts the burden to tax authorities to prove wrongdoing, rather than requiring savers to prove innocence. That's a big shift. Along the leafy boulevards of Buenos Aires, optimism is rising. Car salesman Fabian Luciani says more than half his clients pay in cash, sometimes dollars buried in backyards for years. Customers are getting bolder. There is less need to hide things. Architect Gerardo Kesselman sees clients selling houses in Uruguay, bringing cash back to invest in his apartment complexes. Contrast past versus present. Past: use more than $1,000 in undeclared cash. Risk prosecution. Present: up to $70,000 with the burden on authorities. Copying the past, more amnesties that get reversed by the next government, fails because Milei's law promises deeper changes. Trufa says people are starting to say, hey, maybe this time really is different. Evolution is unavoidable because Argentina needs those dollars to work. Milei's economy minister, Luis Caputo, urges citizens, deposit your dollars in the bank, as in any other part of the world. The opening up of Argentina's nascent mortgage market is expected to boost real estate sales. With more dollars in banks, lending expands. That's the compounding effect Milei is chasing. Now, let's autopsy the key decisions. Decision 1. Milei launches his first tax amnesty in July 2024. What was expected? Milei expected to coax undeclared dollars into the system. Amnesties have been tried before, but often reversed. Skeptics expected Argentines to stay skeptical. What actually happened? It worked. About $24 billion flowed back into the financial system. Argentines declared roughly 55,000 properties. One example, Kesselman's client sold a house in Uruguay and invested in an Argentine apartment complex. Opportunity cost? For holdouts, it was the chance to participate early and benefit from the first wave of lending and investment. For the government, it was political capital spent on giving tax evaders a break. Hidden trade-off? Amnesties reward past bad behavior. The hidden risk is that if trust breaks again, the backlash is worse. Success here plants seeds of expectation. Milei will protect my dollars. If he delivers, compounding trust. If not, compounding cynicism. Decision 2. Congress passes the December law raising tax evasion thresholds to $70,000 and shifting proof burdens. What was expected? To unlock more cash faster. Previously, even $1,000 risked prosecution. Now, $70,000 is safer. What actually happened so far? It's early. The law will take months to implement. But safe deposit businesses like Ingot predict a 15% decline. Car salesmen see bolder cash buyers. Real estate developers expect a boom. Opportunity cost? Tax revenue foregone, in theory. But the article argues the gain in lending, mortgages, and growth outweighs it. Hidden trade-off? It signals to global investors that Argentina is serious about normalization. But domestically, it risks moral hazard, rewarding those who evaded taxes while punishing compliant savers. Decision 3. Milei's austerity measures alongside these incentives. Austerity hurts in the short term. Peso pain, inflation pressures. But it's paired with dollar incentives, expected to build credibility with markets. So far, dollar deposits up 160%. Opportunity cost? Short-term pain for voters. Hidden trade-off? Austerity without dollar trust is just suffering. With trust, it's the foundation for compounding growth. Now, on screen, alongside the dollar deposits chart, show a photo of car salesman Fabian Luciani in Buenos Aires. You see him in a showroom, perhaps with cars behind him, leafy boulevards nearby. That image measures street-level change. It matters because it grounds the numbers in behavior. What people miss is the psychology, from hiding in chair legs to boldly buying cars. Reality check time. Uncomfortable truth. 1. $250 billion hidden is 6 times central bank reserves. Even the record $37 billion in banks is a start, not the finish. Argentines are traumatized. Economist Gustavo Lazzari says, that memory is passed down from parents and grandparents. Truth 2. Signal versus reputation. The numbers show progress. 160% increase in deposits. But reputation lags. Argentina has announced dozens of tax amnesties over the years, only for rules to reverse and governments to chase declared assets. Perception, this too shall pass. Truth 3, where perception lags, reality is in Milei's staying power. 2 years in, he's won global fans. Dollar deposits are up. But if he can't deliver sustained peso stability, the mattress wins again. Lessons. Lesson 1. Incentives shape savers' behavior more than lectures do. Milei gets this. Raise thresholds to $70,000, shift-proof burdens, amnesty $24 billion. Result? Deposits up 160%. Lesson 2. When cash becomes a liability, optionality shrinks. Hoarded dollars preserve value but can't compound. They sit in teddy bears, vulnerable to floods or theft. In banks, they fuel lending, mortgages, growth. Cash under the mattress is safety, cash in the system is progress. Lesson 3. Success plants failure's seeds when trust is fragile. Amnesties work until the next reversal. Milei's reforms must compound over time. If they do, Argentina escapes the cycle. If not, cynicism deepens. The core question: can Milei get those $250 billion mattress dollars working for Argentina? Yes, if he sustains incentives and stability. The deposits chart shows it's starting. The sentence to remember: in economies of distrust, the real currency is credible incentives, not promises. Moving to next title: a home battery backup will help in next outage. A late December blackout in San Francisco hit about 130,000 residents, and the author's family coped fine. But they know they need to be more prepared for next time. That's the wake-up call in this Wall Street Journal personal technology piece. And it matters because power outages are not rare events. California's planned shutoffs for wildfire risk jumped 145% last year compared with 22.4. Winter storms in the east leave people without power for days in freezing temperatures. As investors, we obsess over business quality. As homeowners, we should obsess over household resilience. I see this as part of a repeating cycle. Grids strain under weather, demand, or age. Outages multiply. People scramble for generators that are noisy, smelly, high maintenance, and fume-emitting. Then batteries drop in price and scale up in capacity, offering a quieter, cleaner path. Founders like those at EcoFlow, Anchor, Jackery, and Tesla are building that path. Let's identify the central figures, the founders and operators behind these batteries. First, the portable power station makers: EcoFlow, Anchor, Jackery. These companies are builders. They're building a new category: huge phone bricks that charge when power is on, then keep your essentials running when it's off. EcoFlow's 256 watt-hour River 2 costs $180 and covers laptops and mini fridges. Anchor's C2000, $799, powers more. Jackery has a wattage calculator tool. They're allocators. They allocate engineering to key specs: capacity in watt-hours, output in watts, peak surge watts. Lithium iron phosphate batteries, LFP or Li-Fe-Po4, the same as in EVs, for longevity. Cheaper lithium ion for budget options. These choices determine how long your fridge runs or if your kettle boils. There are constraints too. Heavier models have wheels and weigh over 25 pounds. Air conditioners need huge surge power. Only high-end batteries handle it. Output must match appliances. A 1,500-watt kettle needs at least that rated output. Then, the whole home players. Tesla with its Powerwall. Tesla's 13.5 kilowatt-hour Powerwall costs over $15,000 installed and lasts more than a decade. Pete Timms of Quantis Solar installed an EcoFlow Delta Pro Ultra Plus expansion battery, 12.2 kilowatt-hours, for $7,500 total. Operators like Timms are key allocators. He advises stacking batteries and plugging into your panel for manual switching to save thousands versus automatic. For a recent client, he added a transfer switch and bidirectional EV charger to use a Cybertruck, equivalent to more than 6 Powerwalls, for $7,000, vehicle not included. What worked for a long time was gas generators. Noisy, smelly, high maintenance, toxic fumes. Not for apartments. Just 14% of American households own one. They emit carbon monoxide, require venting, and guzzle fuel. What quietly stopped working was assuming the grid is reliable. Outages are up. California's shutoffs jumped 145%. Multi-day blackouts freeze families. Marielle Mango of Clean Energy Group says assess vulnerabilities. Medical needs like CPAP or refrigerated insulin make it an easy decision. The inflection point is batteries scaling up and dropping in price. Portable stations start at $100 for essentials. Whole home at thousands. EVs like Ford F-150 Lightning, Chevy Silverado EV, Tesla Cybertruck, Rivian R2 reverse power flow. The author plans a 2 kilowatt-hour portable for $800. Expandable. Contrast past versus present. Past, scramble for generators during outage. Present, charge battery ahead, plug-in fridge, router, heater. Copying the past fails because generators don't fit modern life. Apartments, noise rules. Emissions, evolution is unavoidable as grids age and weather worsens. Capital allocation autopsy. Decision 1. Go portable. EcoFlow, Anchor, Jackery. Expected. Keep essentials like Wi-Fi, 15 watts, fridge, 100 to 200 watts, 1000 watt surge, space heater, 750 watts. Actual. Anchor C 2000 at $790 covers 2,500 watts continuous for hours. Add expansion for more. Opportunity cost. No whole home coverage. Hidden trade-off. Portability means manual plugging. Surge limits mean no heavy AC. Success. Cheap. Easy. Carried too far limit scale. Decision 2. Whole home like Tesla Powerwall. Expected. Automatic power to all outlets during outage. $15,000 for 13.5 kilowatt-hours. Actual. Timms stacks EcoFlow for $7,500 manual. Covers average home 5 to 12 kilowatt-hours daily. Opportunity cost. Upfront capital. Hidden trade-off. Gas heat controls need power. AC drains fast. Decision 3. Use your EV as battery. Cybertruck equals 6 Powerwalls. $7,000 install. Expected, massive capacity. Actual, bidirectional charger needed. Opportunity cost, vehicle price. Hidden trade-off, EV must be home, charged. On-screen, first the San Francisco blackout photo. Dark streets, stalled robotaxis. Discarded dough. Measures vulnerability. Matters because it's real. Creator says, this could be you. Then appliance list. Wi-Fi 15 watts. Fridge 100, 200 watts. 1000 surge. Space heater 750 watts. Total at least 2,500 watts. That table measures needs. Matters for sizing. What people miss? Surges kill small batteries. Reality check. Truth 1. Outages are rising 145% in California shutoffs. Truth 2. Generators suck for most, just 14% own one. Batteries quiet, no upkeep. Truth 3. Perception lags reality on costs. Powerwall $15,000, portable starts $100. Lessons. 2. Scale is disadvantage if inflexible generators don't fit modern constraints. 3. Success, grid reliability, plants failure. Outages, prepare by allocating to resilience. Core question: how to back up for the next outage. Portable for essentials, scale to whole home or EV. Sentence: in a world of unreliable grids, the best compounder is the battery that turns. Moving to next title, the chips are down, PepsiCo to cut snack prices after outcry. Retail prices for salty snacks were about 38% higher in June 2024 than in 2020. And PepsiCo is now cutting prices by as much as 15% on Lay's potato chips and Flamin' Hot Cheetos, after a flood of shopper complaints. That's the core tension in this Wall Street Journal story. And it matters because it's a masterclass in consumer power versus corporate pricing discretion. PepsiCo bet big on loyalty to its brands amid inflation. Shoppers said no through emails, voicemails, and wallets. And now management is pivoting. As value investors, we watch these moments. When does pricing power crack? I see this as a repeating cycle. Food companies hike prices post-shock. Like COVID, consumers tolerate it briefly, then trade down to private labels. Volume slows. Companies face the choice: hold prices and lose share, or cut and claw back volume. PepsiCo chose the latter. Let's zero in on the central figures. PepsiCo's U.S. food business CEO, Rachel Ferdinando, and overall CEO, Ramon Laguarta. Ferdinando is the operator here. She's a builder. She built the pricing strategy that drove short-term gains. Post-COVID, PepsiCo steadily increased prices across snacks. Consumers told her they need more value. Her response? Cut prices up to 15% on key items like Lay's and Cheetos. She's an allocator. She's allocating shelf space, marketing dollars, and now price concessions to high complaint items. Instead of spreading cuts everywhere, focus on what shoppers scream about. She's a constraint. Constrained by slowing sales. Organic revenue in North America foods went from plus 2% in first quarter 2025 to minus 2% in Q4. Beverages from plus 1 to minus 3. Consumer outcry became the binding constraint. LaGuardia, as CEO, is the top allocator. He oversees the bet on pricing power. It worked until it didn't. Now he's backing the cuts. What worked for a long time was relentless price increases. Post-COVID, food companies targeted snack aisles. PepsiCo led, prices up 38% by mid-2024. Consumers stayed loyal at first. Margins expanded. What quietly stopped working was assuming brand moats were infinite. Restaurant traffic declined 1.9% last year as shoppers pulled back on high prices. Many shifted to cheaper private label or store brands. PepsiCo's volume slowed. Organic revenue turned negative. The inflection point is shopper feedback turning into action. Consumers told us they need more value, Ferdinando said. Flood of emails and voicemails. PepsiCo responds with 15% cuts. On screen, the revenue table. 4 columns. Quarters 1 through 4 2025. Rows, North America food and beverages, organic revenue change year over year. Food. Q1 plus 2%, Q2 plus 1, Q3 minus 1, Q4 minus 2. Beverages. Q1 plus 1, Q2 0, Q3 minus 2. That table measures momentum loss. It matters because it shows pricing power eroding into volume loss. What people miss? The acceleration downward. Creator says this can't continue. Next, the stock chart. Line chart. PepsiCo versus S&P 500. Year-to-date from January 2026 to February 3. PepsiCo down about 6%. S&P up about 9%. Measures relative underperformance. Matters for investors. What people miss? Staples lagging growth amid value backlash. Environment changed. Inflation peaked. Shoppers price sensitive. GLP. 1 drugs. Fitness trends add health pressure, but core issue is value. Past. Hike freely, consumers pay. Present. Outcry forces cuts. Copying past fails, more hikes lose share forever. Evolution unavoidable. Staples must balance margins and volume. Capital allocation autopsy. Decision 1. Steady price increases post-COVID. Expected. Capture inflation, expand margins, leverage brand loyalty. Actual. Prices up 38%, but volume slowed, revenue negative. Opportunity cost. Market share to private labels. Hidden trade-off. Loyalty finite when alternatives cheaper. Success. Margin gains carried too far into share loss. Decision 2. Ignore early slowdowns. Q1 food plus 2, expected continuation. Actual, Q4 minus 2. Opportunity cost, earlier cuts could retain volume. Hidden, consumer habit shift harder to reverse. Decision 3, cut prices 15% after outcry. Expect. Moving to next title, PayPal swap CEO warns on profit. Alex Chris was not in line with expectations, so they're swapping him out for Enrique Lores, effective March 1st, and warning earnings will decline in 2026. This Wall Street Journal story captures a classic inflection. A payments pioneer loses its edge, execution falters, board acts. It matters because PayPal built the digital wallet moat, but now branded checkout sputters, shares tumble 20% to $41.70, down over half in a year. We value investors watch for these. When does the founder's vision turn into operator's burden? It's a cycle. Fintech founders disrupt incumbents, success breeds bloat. Competition erodes moats, execution slows. New CEO comes in to cut, refocus, compound again. PayPal's at that turn. Central figure 1, Alex Chris. Outgoing CEO. Chris was builder. He built diversification away from branded checkout. Debit card push, Venmo profitability. Venmo payment volume grew 13%, up 3 points year over year. Allocator. Allocated to new streams amid branded checkout slowdown. But merchants have competing priorities, require more hands-on support than anticipated. Constraint. Constrained by macro, weak U.S. retail, lower middle income pullback. K-shaped economy. Branded checkout volume up just 1% versus 6 prior. New figure. Enrique Lores, incoming CEO from HP. Lores is operator reset. Board bets he'll enforce pace. Interim Jamie Miller takes over. What worked long? Branded checkout dominance. High margin, key indicator. Grew fast once. Stopped working, macro hit, plus execution gaps. Deployment issues, slow integration. Revenue 4% to 8.6. 8 billion, missed 8.79 billion expected. Adjusted EPS $1.23 versus $1.29. Inflection, board says, pace not in line. Shares down 20%. Changing. Leadership, priorities. Past. Diversify amid slowdown. Present. Hands-on merchant wins. Investments in AI shopping, buy now, pay later. Copying past fails. More slow execution loses share. Evolution unavoidable. Fintech moats erode fast. Decision autopsy 1. Chris diversification push. Expected. Offset branded checkout. Actual. Branded volume 1%. Overall revenue miss. Opportunity cost. Neglected core. Hidden. Execution lag signals weakness. Success. Early growth. Carried too far into neglect. Expected. Time for turnaround. Actual. Pace too slow. Cost. 20% stock drop. Trade-off. Stability versus urgency. Decision 3. Pick Lores. Expected. HP discipline. Actual. TBD March 1st. Cost. Interim uncertainty. Trade-off. Outsider fresh eyes versus internal knowledge. On-screen. Share chart. Line. PayPal versus S&P. Past year. From March 2025 to now. PayPal plunges minus 50%. S&P plus 20 or so. Measures destruction. Matters. Fintech lag. Miss. K-shaped recovery hurts PayPal's base. Creator. Wake-up call. Reality check. Truth. Branded checkout. Highest margin. Down to 1% growth. Signal. Venmo 13% good. Reputation. Execution not in line. Perception. PayPal safe staple. Reality. Half value gone yearly. Lessons. 1. Incentives. Merchants prioritize elsewhere, force hands-on. 2. Scale disadvantage. Big merchants demand more support. 3. Success seeds failure, diversify too soon. Core rots. Core question. Can PayPal execute under new leadership? Yes, if Lores refocuses core, cuts bloat. Sentence. In fintech, execution compounds moats or destroys them faster than any rival. Moving to next title. Nintendo backs Annual forecasts. Nintendo's net profit for the 9 months ended December rose 51% to 358.86 billion yen, already exceeding the full-year forecast of 350 billion yen. That discipline stands out in this Wall Street Journal article, and it matters because in gaming, hype kills as often as hardware flops. Switch 2 has sold 17.4 million units since its June launch, topping Sony's PlayStation 5 in U.S. sales by volume and value, according to Circana. Nintendo refuses to chase the euphoria. As value investors, that's the moat we crave: execution plus restraint. This fits a pattern. Console cycle peaks, Switch 1 rode the pandemic wave, successor launches amid supply squeezes from AI chip demand. Founders like Nintendo's team allocate to IP diversification while constraining forecasts. Repeat. Central figure: President Shuntaro Furukawa. Furukawa is the builder. He built the Switch 2 launch, $450 retail in the US. Larger responsive screen, enhanced graphics, 17.4 million units sold by December. Best-selling console in US per Circana. He's allocator. Secured partners for stable memory supply despite AI boom. Software push: Mario Kart World 14 million copies since launch day. Donkey Kong Bonanza 4.25 million since July. Revenue nearly doubled to 1,906 billion yen. He's constrained. Chip prices surging, stock down nearly 5% year-to-date. IP income down 10% to 54.5 billion yen on lower movie revenue. Maintains conservative guide: 19 million hardware, 48 million software by March end. What worked for a long time? Disciplined cycles. Switch predecessor, amplified by pandemic. Switch 2 replicates: hardware 17.4 million, software 37.9 million already. Profit up 51%. What quietly stopped working? Hardware purity. AI memory crunch threatens margins. Furukawa warns persistence could weigh profitability. Revenue streams need broadening. Inflection point: 9-month profit tops full-year guide, yet holds 19 million unit forecast. Past: smooth launches. Present: supply rigor needed. Copying past: upping guidance risks miss if chips spike. Evolution unavoidable. Movies parks leverage IP. Capital allocation autopsy. Decision 1: launch Switch 2 June despite chip risks. Expected: replicate predecessor success. Actual: 17.4 million units, top US seller. Opportunity cost: none yet. Hidden trade-off: margin pressure if memory persists. Success: sales, could carry to profit squeeze. Decision 2: hold 19 million full-year guide. Actual: implies just 1.6 million Q4, low bar versus last year's 1.3 million old Switch. Cost: investor frustration. Trade-off: under-promise, over-deliver. Decision 3: diversify IP, Super Mario Galaxy Movie April, Zelda Live Action 2027. Expected: revenue beyond hardware. Actual: IP down 10% short-term. Cost: upfront spend. Trade-off: cyclical stabilizer. On-screen: net profit chart. 3 bars: FY 2204 baseline, 2205 up, 2006, forecast higher. 9-month bar at 358.86 billion yen, plus 51%, topping full-year 350 billion. Measures compounding execution. Matters. Conservative guide amid blowout. What most miss? Q4 low bar signals caution. Creator says strength hides risks. Next. Sales callouts. Switch 217.4 million. Software 48 million forecast. 37.9 done. Mario Kart 14 million. Donkey 4.25. Revenue 1,906 billion. 93% guide to 2,250 billion. Now, towards last article, can deportations lower housing prices? The Trump administration claims deportations free up housing for Americans, citing drops in home listing prices in Austin, San Diego, and San Jose. But economists say oversupply and domestic moves explain it better. This Wall Street Journal property report cuts through the noise, and it matters because housing is America's pain point, with frustration boiling over. DHS touts 3 million immigrants gone, including 675,000 forced deportations. Yet rents decline where ICE targets and builders offer discounts. As value investors, we dissect supply-demand incentives, not politics. Pattern: policy shocks promise quick fixes for structural shortages. Demand side tweaked. Supply lags. Markets reveal truth via prices. Deportations test: reduce demand, lower prices. Central actor: Trump administration and DHS. They're builders of narrative. Want affordable housing? Help report illegal aliens. Aggressive push: verify 200,000 tenants in federal housing. Target apartment buildings. Allocators: allocate ICE resources to immigrant-heavy areas. Minneapolis, LA, Houston. Florida survey: 60 to 7% multifamily owners report negative impact filling units. Texas, 21% significant negative. Constraints: labor. Immigrants 1/3 construction workforce. Harder to build, some lift prices. Trump: keep owners wealthy, no value destruction. What worked? Rhetoric resonates. White House credits deportations for price drops. DHS social media pushes reporting. Stopped working. Evidence gap. Rents fell pre-crackdown in targeted cities. Oversupply drives discounts. Inflection: enforcement ramps but builders discount anyway. Changing: policy pressure on demand. Contrast: past blame shortages on immigrants. Present data shows supply glut. Copying past: more deportations, fails without builds. Evolution unavoidable. Supply must grow. Decision Autopsy 1. DHS Tenant Verification Order. Expected: free units for citizens. Actual: renters scared, vacancy insubsidized. Opportunity cost: trust loss. Trade-off: short-term optics, long-term admin burden. Success: enforcement carried to fear, not flow. Decision 2. Target apartment buildings. Expected: quick demand drop. Actual: Aon nonprofit sees ICE activity, tenants hide. Cost: smaller owners struggle. Trade-off: hits low end most. Decision 3. Tout 3 million departures. Expected: prices crash. Actual: $4.39 monthly rent save per consul estimate. Cost: ignores construction labor gap. On screen, annual growth rates chart. Line graph 2015, 2024. 3 lines: median rent, median home values, foreign-born population change. Housing up 5.25%, population flat to plus 5%. Measures: demand not driver. Miss: supply lags policy. Creator: correlation weak. Reality check: truth. Deportations hit small owners, low-income suburbs. Aon: tenants too scared to open doors. Signal: Florida 67% negative impact. Reputation: free housing. Lag: $4.39/month trivial. Lessons: 1. Incentives: construction labor. 1/3 immigrants. Deport build slow. 2. Scale disadvantage. Oversupply trumps demand tweak. 3. Success rhetoric seeds failure. No supply. Core question: can deportations lower prices? No. Supply shortage structural, demand minor. Sentence: housing fixes compound from shovels in ground, not cuffs on wrists. This is Avi. Like and subscribe. On to the next.